Market maker, market maker, market maker. When you're buying a leap, and let's go ahead and put it on here. It's a Google $800 call. All right. 1430 by 15. Now, pro traders have been taught to understand that those went from $12 to $15, but they're top heavy because they are. They're bloated. Is the market maker going to sell short? When we were looking at them, we were way back over here. And we were looking at, you know, we would have liked to have picked these up right around $5.50. But then Google, you know, once again did its thing. They did go from 14 down to 11. They did drop $3 back over here. They sold off over here. Then during the holiday, you have 3.5 days up here and this last couple of days of New Year's. They're bloated. They have to come back, set an alarm at 12:50. Someone else set an alarm at 11:50. And someone else set an alarm at 10:50. Because they need to drop all the way back down here so that if you buy 10 contracts for $10,000 and one day you cash them in for $50,000, you would be feeling well. So that's the $800 call. It's bloated. It's floating. And it could go higher, but we would never buy something that's floating. And if we go into an earnings report and the call contracts are up here, we ain't buying no calls on the earnings. Because what happens is, the next day, stock might move up $1.50, $1.60, but they gap the calls down here. So, when we look at earnings and we're bloated or floating up at the top, they have a tendency to steal premium, and or if they, you know, stock drops only a couple dollars and after hours, they'll strip that premium all the way back down here and then buy it the next day. That's the glory of taking advantage of the market on the earnings. You don't buy calls when they're up here. So we've got a tape. I'll name the tape, and that's the Google trade for the $800 one.